Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of July 7th. I want to thank you for joining us. I want to remind you and encourage you that if you enjoy these videos and you find them informative, make sure to like the video and subscribe to the channel. And if you have a couple extra minutes, check out some of the other great content that we post here on the channel. So with that said, as always, my intention for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. And with that, let's get ready to hit the books and get up to speed on the markets. Looking back at last week, of course, the big news last week was the passing and signing of the One Big Beautiful Bill. This tax cut and spending package was the cornerstone of the Trump administration's second term agenda. It also is going to receive plenty of attention and analysis over the next few months, including here by John G. Ullman and Associates. So for today, I'm going to limit my overview to just the higher level topics. The centerpiece of the One Big Beautiful Bill is the extension of the 2017 tax cuts. It also incorporates moderate tax cuts on tips and overtime, and some additional deductions for older Americans, 65 plus. It also includes an increased amount of government spending on both the military and immigration enforcement, while a reduction in spending on assistance programs such as food assistance like the SNAP program and healthcare assistance in the Medicaid program. Moving forward, in addition, this bill increases the debt ceiling by $5 trillion and is forecasted to increase the national debt anywhere from an $11 trillion reduction in the national debt, as forecasted by the White House, up to a $2.5 or more trillion increase in the debt, as forecasted by a lot of the objective financial analysis firms, Congressional Budget Office, Committee for a Responsible Federal Budget, and so on. Last week, we also saw the national unemployment reports for the month of June. One big surprise was that the ADP private employment report showed a 40,000 job loss in the month of June, while at the same time, the Bureau of Labor Statistics produced their national unemployment report, which showed a 147,000 job gain in the month of June and showed the unemployment rate dropping from 4.2 to 4.1%. One of the more worrisome aspects of this June unemployment report was that we saw labor force participation rate at recent lows. We also saw the number of long-term unemployed increase by a significant amount. These are folks who have been unemployed for at least 26 weeks straight. And we saw that the number of workers who are considered discouraged or loosely attached to the labor market increased by over 200,000 workers. Not surprisingly, this is what a lot of theories suggest happens in a low hire, low fire environment like we've seen in 2025, is that not many workers are losing jobs actively, but those that have lost jobs are really struggling to find new jobs. And at some point, when folks have struggled for months and months and months and had no luck finding new employment, they tend to become discouraged and either stop looking or stop exerting as much effort towards job acquisition as they would have otherwise. Both of these are concerning developments and things that we'll continue to watch moving forwards. We also saw data last week on the trade deficit, and unfortunately it wasn't good, as the trade deficit increased by 19%. Now, the majority of that shift in the trade deficit, meaning the difference between the amount we import and the amount we export, was driven on the goods side as opposed to the services side. There was an $11 billion increase in the goods trade deficit, as we saw exports of goods fall significantly, and we saw the import of goods increase significantly. Ultimately, what does this tell us? It tells us that despite the tariffs, importers continue to import goods from abroad, meaning that those additional tariff costs are being borne by the employer, the importer, and potentially the consumers at some point in the future. It also shows us that the loss of exports, meaning the loss of sales to foreign consumers and foreign businesses, is having a negative and significant impact on our overall trade balance. Neither of these pieces of information is incredibly positive as far as global and international trade is concerned. On a more positive note, it was a great week in the stock market. The S&P 500 and the NASDAQ both reached 3 record highs in spite of the fact that it was a shortened trading week because of the holiday. We also saw the Dow Jones Industrial Average increase about 0.7% to end the week within striking distance of its own record high. All of this in spite of the uncertainty that continues around Liberation Day tariff pause that will expire this week, the uncertainty at the time about the One Big Beautiful Bill, and the ongoing uncertainty about potential economic slowdown and geopolitical and conflict risk around the world. Now, if we flip to the other side, on the fixed income side, we saw the yield on the 10-year Treasury increase by about 10 basis points. Ultimately, what some analysts are suggesting is that the better-than-expected jobs report has now essentially eliminated the possibility that we'll see an interest rate cut in July, pushing expectations for the next interest rate cut back to September. As the expectation of interest rate cuts have been delayed, realistically and as expected, the yield on the 10-year Treasury increased in response to price in this new information. Turning our attention to Bitcoin, Bitcoin had a strong week. It was a little quieter and a little weaker in the front end, but the news of the positive jobs report alleviated some of the concerns about a potential economic slowdown and pushed Bitcoin up to about $110,000 to end the week. We saw a similar response in the market for crude oil, as some early up and down behavior was essentially offset by the end of the week with a strong recovery, and the price of crude oil rose slightly. The US dollar ended the week ultimately flat after some early losses on the front end of the week and a little bit of a recovery towards the end of the week, in part because of the strong jobs report. We also saw the market for gold ultimately end the week up slightly, but down from where the initial behavior in the market suggested. And remember, gold is traditionally a safe haven, so as fears of economic slowdown are alleviated, some of the demand for gold as a hedge or as a safe haven is removed. Taking a look at the week ahead, the big topic of discussion will most likely be tariffs. It's actually a relatively quiet week as far as economic data is concerned, so a lot of attention will be on the temporary 90-day pause of the April 2nd Liberation Day tariffs expiring on Wednesday. Although there have been mixed messages and at times conflicting information coming out of the Trump administration, it does seem as though at this point those tariffs will now continue to be paused through August 1st. There haven't been a significant number of deals made. Right now we've seen partial deals with the United Kingdom and with Vietnam, and an agreement to the structure of a deal with China. But we haven't seen the flurry of deal making that some had expected. Ultimately, what seems to be the case is that the tariffs will be extended, or the pause will be extended through August 1st. Negotiations will continue, And we will most likely, throughout the week, hear more information about the Trump administration and their long-term plans for tariff policy. As we do every week, we'll also see our weekly unemployment insurance reports. The last few reports have been better than expected and showed a softening of the downward trend in the labor market. But the big question, of course, is what does this week show? Is it going to show a continued moderation in the deterioration of the labor market? Or is it possible that we see a resumption of concerns and deterioration? Some other economic data this week, we'll see the May data for consumer credit and give us an idea of how consumers borrowing money and extending credit has changed over the month of May. We'll also see wholesale inventories for May, how businesses and wholesalers have changed how much they're holding in inventory. And last but not least, towards the end of the week, we'll see the monthly Treasury statement, which will give us an idea of what the federal government's budget looked like in the last month. Looking further out into the future, the stock market seems to have a solid upward momentum right now. And the big question is whether anything can or will disrupt that. The bond markets seem to be a little more cautious and maybe anxious in light of questions about the debt, questions about interest rates, and questions about delinquency and economic slowdown moving forwards. We, of course, also face conflict, global conflict issues, trade and tariff issues, and ongoing geopolitical challenges. With that in mind, it's very difficult to anticipate what this administration will do or say over the next few weeks. But what we can do is we can promise you that we'll be watching whatever it is. We'll be reading the reports, we'll be analyzing the data, and we'll be reading the analysis from the experts, bringing you the most important information in an easy to understand format, helping you keep up to speed on the markets. So with that said, come back and join us again next week. Thank you for joining us this week, and good luck.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.